was, one of the trades I looked at the other day was on ES. And what I want to do on ES is I'm going to sell we're going to sell 3 puts on ES, and we're going to go out 100 days. So essentially what I'm doing, if we take a look at ES, I want to explain this trade. It's a downside hedge trade. So let's take a look at what I would have done. I think we did the September 17th one. So, all right. So taking a look at this ES trade, what I would do is I'm going to roughly 5 delta. Geez, I can't even show those on here. So if I looked at a 5 delta ES trade, and what I'm going to do is I'm going to sell 3 of these. So I think I sold the 2200 is what I did, but using Tastyworks. Oh, I'm sorry, it wasn't 5 delta. I take that back. So what I did was I sold the closest to $3. So yeah, so here it is. So I sold this 2200 the other day for close to $3, and I'm selling 3 of these. I know that's my default, so I'm not gonna, I can't put it all on here because this is a legged in type of a trade. So essentially what I'm going to do is I'm going to sell a put here at roughly $3, and I put this on the other day, I think at 315, so it's down a tad today. It's at like 310, 312. So this is perfect. So this would be essentially what I would be putting on here. Yeah, I'm not worried about all of my buying power and all of that right now, but I'm not even worried about the profit on it. I'm just putting these on at $3 or $3, and I'm going to put 3 of these on. What I'm going to then look to do is I'm going to wait until until the strike that is closest to it here, which is going to be about 50 away. I'm going to wait till this strike gets to about $1.50, and I'm going to buy 5 of these. So I will sell 3 of these. It's going to cost me like 900 on those. I'm not worried about the margin piece right now. And then when this gets to about $1.50, I'm going to buy 5 of these at $1.50. So if that makes sense, and essentially what that's going to give me is a long hedge here that I paid for 5 of these longs by using these. And then as these start to deteriorate down, I will close these out. So essentially I'm buying my long hedge down here by selling, and I'm doing them in a different format. So I'll explain more of this later. I'm just starting to play with it a bit now, but I will explain more on that. But essentially I will go to about $3. I will sell 3 of those. And then as soon as the strike right above it, the 50 point away, as soon as these drop to about $1.50 or so, I will buy those using proceeds from here on it. And that will give me essentially a free long on there. And I'll do it periodically as we start to move up. And essentially, these are just big black swan hedges. So talked to Bobby Gaines on this one a bit. So something we're playing with, and we'll see what happens. So there's at least something unique on buying some hedges. We're still heading up here, but I wanted to get some negative stuff into the account today, some negative delta. So our MES trades are doing fantastic. They're up again today. We've been in these a little over a month now. Actually, this is 2 months, but it took me a month to build them up, and now I'm pulling them off one by one. So that's been a good, solid trade on MES. We're also in AMD. And AMD is performing extremely well here. So we closed our AMD out the other day, resold at 84. So we owned the stock up here. We were assigned at 86. I resold the 84s for this week, or I'm sorry, for next week. And with the premium we've taken in, this is at least a wash or better. So we'll see how we go. We jumped up significantly today. So this trade is looking really good. Our 86 shares are doing well. They're only down a little bit now. And our call here at 84, something that maybe it'll get tested. If so, we'll roll it out, roll it up. But we're doing well, and AMD looks really good coming off of this low. So we're in AMD. On IWM, what I did on this one is this continues to be our hedge trade, where we bought the 235. I'm sorry, I bought the 250. So I bought the 250 put up here. So we own the 250, which gives us nice negative delta. And then we've been selling puts against it. And we recently just sold on Friday the 223. So here's where we are. So we sold this put. And what we've been doing is I'm annualizing this one by I took the total cost of this 250 put that it cost me to put this trade on. I divided by the number of weeks remaining that I hold this on. And then whatever that dollar amount is, which is usually about $1.40, $1.30, something like that a week. I've been selling puts at that dollar amount. So I'm slowly paying this off. This thing is now, I think it cost me originally $29. The cost basis is now, I'm sorry, it cost me $25. The cost basis is now, never forgot. It cost me $29. Sorry, but it's now down to a $23 cost basis, and the value of this thing right now is 25. So even as we're moving up towards that, it's all good. We've been paying this thing down. So essentially we've got a nice, nice little gain going in this thing so far. So overall, this is it's giving us positive theta. It's giving us negative gamma. It's giving us positive vega. So it's nice. So, and it's giving us, so positive theta of about 30, negative delta of about 80, positive vega of about 54, and negative gamma. So this is a positive vega, negative gamma hedge that's giving me theta decay while I have a hedge on. So it's pretty nice. Sorry, didn't mean to stop screen sharing. All right, so hopefully that explains IWM, which is fine. So today that one's down a little bit because you have negative delta in an account, but the nice thing is it's got positive theta, and that's offsetting that to an extent. But it's in there as a portfolio adjustment tool. Palantir. So we're in Palantir. We have a $22 put on. We are above that put right now. So that thing is down to about 15 cents for the next 3 days. So the question is, again, do you want to wait 3 more days to make 15 more cents? I probably want to make another 5 to 10. So I'll give it another day or 2. We'll see what happens. Although we're in good shape on this one. Squeeze has fired coming off the lows down here. So that Palantir trade's a nicely profitable trade on Palantir. RUT, what did we do on RUT? So RUT, we entered another butterfly trade on this one. The last one was a $15 profit, or 15%, I should say, profit. on that one in about 2 weeks. So we entered another one here, 60 DTE. We centered it at 2250. So it's centered at 2250. We're at 2286. So if we hit 2290 or so here, we will look to add a second tier to this thing. It is firing in the squeeze. It's up a bit, but overall the trade is basically flat. I think it's in the hole about 48 bucks overall on about a $500. Let's see where it costs us about $1,000 worth of margin, so down 5%, something like that. All right, so there's RUT. That's where we stand on RUT. And the nice thing about that RUT trade is that's also giving us negative delta and positive theta. So again, we just added negative delta, so we're good to the downside. If the market continues to push higher, then that's fine. We'll let the positive trades work for us. SPX, we're in here with a bunch of different trades right now. We've got 2 iron condors that we put on at a little over $6 on these. I can show some work, but here, $6.10 on one, $6.25 on the other. I'm looking for $2 on those. They were at 100 DTE. One's at 565. The other one's at $5.08. So we've already taken out, not quite it. We've taken out $1 on one of them and about 60 cents on the other. 36.80. Yeah, about 50 cents on the other one. So those are giving us some good positive trades. We've also have 3 calendars on. Do we have 3 calendars or 2? I think we have 3 calendars. So 4180 calendar. Yeah. Let me make this adjustment really quick here. 180, 40. All right, the 4180 calendar, what we put that on for $16.20. So give me a moment here. I'm going to adjust this one. So we put that calendar on for $16.20. And we're going to close it out for about $18.60 is the goal, which is a 15% gainer. So that one's currently sitting at $16.50 or so. We bought it for $16.20. So that's in the black already, doing well. We have a 4140 calendar we put on for 32. That one's down. Might have to make an adjustment on that one and get out of that calendar. It's longer term, so it's not terrible. And then I have another calendar at 4140, I'm sorry, 4170. We paid $17.95 and it's down a couple cents on these up moves. So we've got a couple calendars that we put on in the money, and those are fine. I also own a SPY put similar to the IWM. But I bought a SPY put. So here's what we did on SPY. If this makes sense to you, it's a portfolio adjusting trade. So I bought the 455 put up here. So we own the 455 put. All right, so we bought the essentially a leap. It's not really a super long leap. It's 121 days, but we bought the 455 put here out about 121 days. And then what we're doing is we are selling puts against it. So we sold the 417 right in here. I gotta fix that. To pay for it. So just like we're doing with IWM, these orange so they stand out. So there, so we have this leap up here that we bought, sort of long, and then we sold. Here's our covered put that we wrote at 417 that we're above, so that's all good. So again, we have negative delta and we have positive theta on this one, a little positive vega and a little negative gamma. So it helps really zero things out. We're also long a VIX spread. So we bought the 2025 spread. Put these on in here if you want to as well, so people can see what's going on. So pretty close. So we have a spread, a VIX spread on. I believe it's the 25, yeah. Almost made it there. Okay, so we have this VIX spread on. We bought it for $1.08. It's at $1.10, so slightly profitable on this VIX. VIX at, hitting a really an all-time, low for the year, right down here at this base, and it's up today. Even though the market's up, VIX is up, and that's a good thing for us. And then, of course, we have the XLY trade, which is a trade where we own way down here. We have the 140 long call, and we've been just writing against it every single month. And actually, we wrote the 175 this week. So there's where we are. So we're just writing calls against it. It's been super profitable. Been a great play for us. So this thing's up quite a bit. We've got a lot of great value on that XLY trade, which is based largely on Amazon, Tesla, McDonald's, and Amazon, Tesla having decent days today, nothing crazy. So there's where that one. Endgame with the XLY call is right now that leap that I bought on XLY is a January. It's got 234 days to go. So it's the January of next year leap. So I'm just letting this thing go. I will look to close my leaps out about 90 days prior to it. So this is the January 2022 leap that I bought. I paid about 25 bucks for that leap. It's worth 35 bucks now. So it's already up almost 50%. I've already made 50% on this in, a short period of time. See if I can look that up on XLY. Bought that back on 3.5. So it's 3 months in, and we've made 50% on this leap already. So it's gone from, again, 25 bucks to 35 bucks, $10 on a $25 trade. So not quite 50% in 3 months. And I'm just selling this. I'm selling this for income, not as a basis reduction strategy. This is just an income generating strategy. I really like Amazon, and I like Tesla, I like McDonald's, and I like Home Depot, which is what the XLY primarily is made up of. So this is my proxy tool that allows me to play these. So you've got a nice nearly 40% plus 50% winner so far on the underlying, and you're just also taking in weekly income on this every single week. Let's see if I can take a look at my, I can get to it. Let me see if I can move the Zoom bar out of the way. Let's see. So XLY so far, I think I've sold G9 to 17. Hang on. Let's see. Let's take a look at. Probably should just show my spreadsheet, make it a lot easier for everybody. So we've made money on the underlying, on selling the shorts, as well as holding the long. I gotta readjust that spreadsheet to account for it. So I'm missing a few. So we've been making money by selling these calls while this thing continues to appreciate. So my end game on that is weekly profits on selling them. And then I'm also just watching this underlying grow and grow and grow. You can also look at it that I'm slowly paying this thing off, and it's eventually going to become a free long. So you can look at it any way you want to. I look at it from I want the weekly income. The appreciation is great. The fact that it's up a couple $1,000, it's great, but that's all unrealized profit. For me, I like realized profit. I'm a weekly income trader, and I need to make money weekly. So that's where we're looking at. Also, the S&P here has sold off and now is barely hanging on to positive, which is now giving us a nice day, since we have all that negative delta in our accounts and we don't have a lot on. So ticks are still positive, but advanced decliners have sold way off from about 420 all the way down to about 150. So things have swung around heavily here, and it's been a steady down move ever since we opened. We broke the 15 minutes to the downside, and we've been selling off. So it's not going to be surprising that we could go negative. S&Ps, again, it's up $7 on the day, but at one point I don't even know what it was. What was it up at the high of the day? But anyway, a lot of red coming up in here. So we need to get some other wheel trades on. We're largely negative on Delta, which is fine, because I do think that the markets are overbought here to an extent. If we look at, bear with me, I had to reload TOS while I'm talking. SPX. Down, it's up $2 now on the day. So I think RSI is not telling you that you're overbought yet. But you're not at the previous high. You got close to it today, but look at this RSI. Here's where we were on the previous high. Here's where we are today. So it's not justifying this trade for us today. So it's not saying, that we're going down, but it is, and it's not oversold, but I just have this, this feeling that we're moving higher on weaker and weaker volume and trades, and we're getting some more selling right now. So it's actually good for all of our accounts. I just reloaded my Tastyworks, and my delta is now a negative 23 with a 417 theta, which is fantastic. So in fact, I'm negative and with great theta. So we're all good. I don't have to make a single move today, and we're up a couple bucks on the day. Well, yeah, $4, $5, $10, something like that. It's just bouncing around on the day. And if we go negative here on SPX, I'm expecting my income to go up even more on the day. But I want to get some new trades on. So if there's something that you guys want to see, let me know. Igor, I don't want to hog the mic here. I already have, but there's where we are on trades. The VIX trade looking really nice. The fact that SPX is sold back down is helping all of our calendars and our iron condors. MES is kind of flat for the day, which is fine. So we're getting some nice decay on that. We have overall on the MES trades, we have about 132 theta. So every day we make 132 bucks just by existing. Not to mention if the market creeps higher, we're making money as these things drop. So it's all good. We'll probably close out our MES here in a little bit and put another one on for the day. And I don't know if there's any stocks you guys want to look at. One thing I wanted to take a look at are some of my favorites. I did not do any research since I'm just coming back from vacation, but DraftKings. DraftKings broke this downtrend line in here. So roughly this downtrend, we broke it. We're coming back down. We're bouncing here. Well, I don't know if we're bouncing yet, but we're back to the 21 and the 8 EMAs on DraftKings. This uptrend line, I don't know if it's a perfect line or not, but we could bounce off of this thing and continue. So I think this is like still a good spot for DraftKings. It's had a nice reversal higher on the squeeze. It's showing some nice movement higher on MACD. I think it's getting a little tired. So we'll give this thing a little bit of a rest, but I think that looks really interesting here. I also think Rocket is really, really interesting down in here. You're starting to get reversal. You're starting to get some positive MACD reversal on the squeeze. I think Rocket, even though for me on Rocket, IV's better. I'm looking to stuff for next week. Probably not a 3-day trade, but you could sell the 15 or 16. Probably I'd be looking at selling the 16 in here, and you get some pretty decent premium for next week on this pullback off of this move higher. So I think Rocket's something to definitely take a look at in here. Somebody posted something in chat. Penn. Like Penn Gaming. I want to look at, I've got Penn and Corsair, so I think they're grouped together on here. Or I thought they were. But here's Penn. Penn looks the same as Rocket did. So you have this reversal area in here on it. And bear with me. Just want to make sure. Okay, sorry. So yeah, Penn, I think it looks good here. The only thing that concerns me on Penn is squeeze is giving you the reversal. MACD, this was a spot down here on a low. It popped. It's starting to weaken again. You're starting to see some selling back in here. It's not holding this 21 EMA, which makes me a little nervous on Penn. While I think you could sell, and I think it's really interesting. I think you could sell something around 75 in here. So I think we have some support. This thing needs to move up. And your downtrend line, it broke as well. So if we take a downtrend line, on Penn. So downtrend line on Penn here. Still, it may have broken it here, and I think you have some support in here. So draw support out. So there's your support. I don't know how far back that thing goes. We'd have to take a look to see if there's any more decent support back in here around that area. Maybe. But you're at a low here, so I think Penn is something that's certainly doable. So you can take a look at Penn in here. I also really like Neo in here. It's really taken off. Here was the support. It's squeeze is starting to fire on this one. Let's see. So that's something to take a look at. In here, I would like to see it come back down, but this was the perfect spot, was this reversal. I'm really looking at these MACD reversals here, where MACD, and if squeeze does, that's fine too, but the MACD reversal from the red to the, the bright red to the dark red, that reversal, these lows, this is where I want to really do a lot more of my wheel trades, and not up here on these pen. This was more the spot, but you're coming back down to that spot. You're not far off of it, so not bad. Workhorse, a little weakened here. And if we look at a few of these, look at American Express, it's taken off. I don't know if there's anything else. And Walmart, interesting in here. I think you've got good opportunities on Walmart. Looks like squeeze is now firing on Walmart, says could be an opportunity. And then if we continue the gaming theme on Win, that one has had a nice move, and its squeeze is now firing on Win. So Win looks good. Could be making a move to all-time highs coming up. So there's a few of those. Any other stocks you want to take a look at? Igor, if you want to jump in, feel free.
Yeah, well, I'm just adjusting a few positions for active trader, but for the most part, I'm going to go over positions that I am holding in Income Navigator group. And, my positions are really slowly moving and not really reacting too much to today's move. We saw a pretty sharp decline. I'm not sure if there was news or this was just algos going nuts over a rumor, but Q's took a pretty decent dive. S&P is still green, and the Russell is holding up pretty well. I haven't seen anything. I haven't really looked for any news of what's causing this action, and I try not to pay too much attention. But positions that I have on are in good shape. I will go over each one, and potentially I was looking for an opportunity to do a scaling income butterfly in the Russell. Those tend to work really well in the markets where we're, headed higher, but not in the straight line. I'm not really sure if this is what we're going to see with the Russell, because when this index gets going, it really goes. I think that Russell is due for a move to an all-time high, which is right around, I'm looking at IWM, and I think that the high is somewhere around 2350. We're currently about 100 points below that level. And if we are going to go towards the high, this should give me a good opportunity to scale into all three of the tiers, right? And for those that don't know the protocol or how this trade works, I will post a link to a video that kind of briefly describes what the trade is. But in a nutshell, we're looking to initiate 3 layers of broken wing put butterflies in Russell, and we don't add them all at once. We initiate one, we wait for prices to move higher, we initiate another layer, and then potentially the third one. And if the price continues to run away or move to the upside, we start to do the roll sequence, taking off the original or the first layer and placing it 40 points above the highest of all 3 butterflies. It might sound like it's a very complicated trade, but if you are familiar with butterflies, it shouldn't be too complicated. Just need to have a plan ahead of time, know where your adjustment points are, and all you would really have to do once you're in the trade, just follow your plan, execute on your predetermined adjustments, and potentially, if we do get a reversion back to the mean, this trade should net about 15% return on total risk. I know Tom did one with, I'm not sure if it was Russell or S&P. I think Gabe just recently did a trade in the Russell, and I don't think he was able to scale all the way to 3 tiers, but he was able to take one off, or I'm not sure how many layers he had on, but I saw
Yeah,
him
I had
post
two. I had two.
2 tranches.
Yeah.
Yeah, so I think that's pretty decent. You know, even if you scale just 2 tranches, and if you're starting to run short on time a little bit, if you are seeing a 15% return on your total position, taking it off and initiating a new one is definitely an option, right? You don't have to force trades in, because I think that the closer we get to expiration, I'm not a big fan of scaling these kind of trades with time kind of running against me, if that makes sense, because the trade becomes way too sensitive to price change or gamma, and you can run into trouble pretty fast. I think it's a lot easier to manage this trade if you have plenty of time until expiration. It's much slower moving trade and gives you a lot more time to think about what you're going to do, where you're going to do it, and whether or not you want to make adjustments, you know, right that same day, or if you want to wait for the following day. But if you start to run into something like a 18 DTE or less, you need to act a little bit faster, because 1 or 2 days worth of movement could really turn the trade upside down. But today's action is really, and this is what I said earlier today. When we open with these plus 1,000 ticks, sometimes that gets sold into, and the tell was that UVXY was kind of pushing higher since the open. In hindsight, and not a fan of hindsight trading, but in hindsight, the iron butterfly that I looked at earlier, that was centered at 42.25, and I think that credit was like $12. So downside break even was, right, we take away 12 from 42.25, that gives us a break even to the downside right at 42.13, and SPX is currently trading at 42.09. So in hindsight, had I placed that trade on, I was actually worried more about upside break even than a downside. But in any case, had I put that trade on, I would have been stopped out of that iron butterfly, since S&P is now at 42.09 and my stop would have been at 42.13. Now I would have to kind of make a decision if I want to go for another round. And I know that a lot of traders that do trade 0 DTE iron butterflies, as soon as they get stopped out, they initiate another round. But the risk here, in my opinion, with S&P at 42.10, if you put one on and say you get another $12 credit or whatever is available right now, if we get back to day's highs, which is 42.34, right, your upside stop is at 42.10 plus 12. So, you call it 42.25. If we get back to day's highs on the S&P, you would get stopped out on the upside. So market gets a little whippy the way it is right now, and it's not the best for iron butterflies, especially with lower implied volatility. You just don't get enough premium to justify taking on that risk when the market moves the way it is. Now we're seeing a little bit of a pullback on the UVXY. This should give the S&P a chance to bounce. Again, I don't know what the news was or what the headlines were when the market took a dip, but we have seen something similar last week where the market just all of a sudden would pull back hard and then come right back, and that gets a lot of 0 DTE trades in trouble quick. I do enjoy doing trades that have a lot more time until expiration, and do understand that they are a lot slower, so to speak, right? So if you're going to make, you know, $1,000 a day trading 0 DTE versus putting on a 45 DTE trade, and you're going to only make $3,000, but you have to wait a month to do it. Sure, I would rather make 1,000 a day than 3,000 in a month, but 3,000 in a month is a lot. I don't want to call it safer, but it's a lot less volatile. And if you could, if you're comfortable trading 45 DTE trades and taking slower gains, then you can obviously increase size, where you could eventually make $1,000 a day over the course of the month because you increase the size of your 45 DTE trades.
If anybody took the put SPX put broken wing butterfly that I posted a little bit ago, it's already trading for double. So I put it for 30 debit. It's already trading. You can close it for 60 credit.
Oh, that's a good one. So it was a 41.55, 41.85, 4,200 for 30-cent debit.
Right.
That's great. Yeah. Let me just actually, you know what? I wanted to show you something really cool. I think that is cool. We have a position in this is Russell put credit spread. I'm going to share my screen in a second, guys. Hang on. All right, so you see my screen, guys?
Yep.
So this is a 50-point wide put credit spread. It was initiated 14 days ago. You can see that Russell moved, we put this on, Russell was at 22.15. Now Russell's at 22.85. So we have about a 70-point move. In standard deviation terms, it's just 0.4 standard deviation. Implied volatility has come down, so that probably helped trade more than anything else. But now we have 31 days to go. The short strike of this put spread is at 2,000, and it is currently delta 7, which implies, and this is based on current implied volatility. Don't take this as a implied probability of profit for this trade is close to 98%. Right, so this trade has about $1.90 worth of credit left. But we'd have to wait 31 days, right, to take out the remaining $1.90 out of this trade. Now, if we wanted to initiate another trade, what we can do is we can take this trade off and move on. This is probably the easiest way to go about this. Or we can turn this trade into a black swan hedge, if you will. right? If we close out the 1950 long puts and we put those in front of the short puts, which will essentially make this into a put debit spread, right? If I buy the 2020 puts, this will be a buy to open, and I sell to close the 1950. This will put me in a 20-point wide put debit spread. And this is what this trade would look like. So I don't have any risk to the upside. I will give up some of the unrealized profit that I'm currently holding in this position, right? And we can see this on this graph, that if Russell continues higher, which is where I think it is going, right? We will end up with about, in this specific position, about $2,400 profit. We're currently sitting on about $3,300 profit. So, we'll give up about $1,000 of unrealized gains, but right, this is what we're giving up. There's always a trade-off, right? We're giving something up in exchange for something. What we are gaining here is a potential for a big profit if the Russell was to move down about 12% from today's from current prices, right? You can see that over the next 31 days, if the Russell moves down 12.5%, if we hit 2,000, right, this 20-point wide put debit spread is going to be worth its max value of 20 points, or $2,000 per one spread. If I have 10 of those, that's a $20,000 profit plus the $2,400 net credit that I currently have in this trade. Based on current implied volatility, we would have to move about 2 standard deviations to the downside from today. From right now, we would have to move 2 standard deviations to the downside in the Russell in order to realize this debit spread's max potential profit, right? So Russell would have to move down below 2,000 for this spread to come into play. Anything under 2020, these options will expire worthless, and this trade will be just a small winner. So it's just an idea. I mean, this isn't what every trade needs to be, right? We can just close out the put spread that we have on, the put credit spread, and move on. Or we can say, all right, I'm willing to give up some of the unrealized profit here in exchange for this hedge. And if you can use this, like you have to determine whether or not you can use this hedge in your overall portfolio, right? If you're holding just a couple of small positions, then obviously you don't need this hedge. But if you have longer dated, long delta, and you think that there is a chance that Russell may, right after this kind of sideways consolidation, in my opinion, I think we're going higher. But if Russell was to roll over and go down to about 2,000, if that's going to hurt your other long delta positions, well, this hedge here could potentially make up for some of those losses. Right, and to do it, if I was to roll the 1950 up to 2020, this is currently going for a 290 debit. So that's one idea. We looked at something similar to that in S&P, and here is another. This is another put credit spread in the Russell. This one is only 5 days old. In the last 5 trading days, or this is 5 I guess, 5 calendar days. We'll put this on last week. Implied volatility has increased a little bit. The Russell went from, I think when we put this trade on, Russell was trading at 2268, and we are currently at 2281. So we didn't move a whole lot, but implied volatility has increased a little bit. This trade is just doing what it's supposed to do, which is nothing. There's plenty of time. There are 45 days until expiration, so a lot could happen. And if I was really concerned about, Russell rolling over, and so maybe doing making the adjustment I just talked about together with the trade that is in the 16th July expiration, that could potentially help. So if I was to close the 1950s and open 2020s, this would take my net delta from plus 52 to plus 22. So I would get rid of just a little bit over half of my long delta. It would cut my theta, but it would, if Russell was to really take a big dive over the next 30 days, I wouldn't be so worried about the put spread in July, because my put debit spread in July 2nd expiration would kind of keep things together here. So this is something that you want to think about in terms of your overall portfolio, or how would one position play into other positions that you may have on, right? If you don't have other long delta positions, maybe this hedge is just a cool idea to think about, but you don't need it. So there's no reason for you to do it. But if you do have positions on that you would like to protect, there's a way to do it for very minimum cost. I'm going to really quickly go through the S&P position. So this one we talked about last week. I brought up the similar idea of getting rid of the put credit spread, just leaving the debit spread. With 10 days to go, it's very unlikely that anything would happen as far as, the price going down below 39.25. But again, just to show you what that would look like. So if I was to close out the 38.25, 37.75, this would leave me with a free, so to speak, a free downside hedge down to about 7.5%. So if you think the market could pull back 7.5% over the next 10 days, this, you could call it free. You would end up with about, so worst case, if the market does not crash, you make $700. If market really goes down hard, to the tune of about 7.5%, you can, risking just about, this would be $400, risking $400, you can make over $20,000. It's very unlikely that this would happen, right? Because we can see that the long put at 39.25 is a 5 delta, which, based on current implied volatility, the market implies that there's only about a 5% chance that the market is going to end, or S&P is going to expire below 39.25. There's a 95% probability that S&P is going to be above 39.25 over the next 10 days, or at the end of this expiration cycle. My plan for this is to do nothing, just kind of leave it alone. Try to close it for 0 right now, or just leave it alone for the next 10 days. And as long as the price is above 39.25, all options that are part of this trade are going to expire worthless, and we just get to keep the 1100 that was collected upon entry into this trade. This one has 38 days. This is a broken wing put butterfly in S&P. Currently showing about an 8.7% return on risk in this trade. We could also look at closing out the put credit spread, and closing out a put credit spread will leave us with a put debit spread with 38 days to go, right? So right now this trade has about a $3,500 unrealized profit. If I was to give that up, right? So my cost for this hedge would be the $3,500. But if the market dips over the next 38 days, 7.5% or more, right? My $3,700 hedge would turn into a $50,000 winner. And we can see that, my long put is at 39.25 over the next 38 days, right? Based on current implied volatility, the markets are implying that there is a 85% probability that S&P is going to expire above 39.25 by July 9th expiration. For now, my plan with this trade is to do nothing, right? We hold it. We can watch some levels on the S&P if we start to pull back deep enough. I don't really like to, touch these trades and make too many adjustments. It just needs to. We have plenty of room to the downside. Like this trade doesn't really get into trouble until 39.25. So just do nothing, let time pass, and that is the hardest part about these trades, right? Do nothing, because we always feel like we have to do something. So for now, it's do nothing, kind of wait and see. If the market starts to go down every day, we move down with speed. I'm talking about over 1 standard deviation moves to the downside, back to back to back. Clearly, the market is telling me that something's changed, right? The market character has changed. Now we're going down over 1 standard deviation every single day, which essentially means that market is moving a lot more than what the market is pricing in. That's going to get repriced relatively quick. And at that point, for me, the decision that I would have to make is whether or not I think this is temporary and maybe it's just a pullback. Do we have any support coming, or if we have any key moving averages that may come into play? And maybe I'll just take this trade off for a smaller win and maybe wait for a deeper pullback to initiate same exact position. Because remember, these trades are best when put on after big sell-offs, right? When you think that odds of reversion or some kind of a V-shape bounce are pretty great, those are the times where you want to initiate this kind of structure. So S&P turned negative. We have the Russell is still green. S&P turned red, and the Nasdaq is down almost 0.5%. UVXY continues to push higher. The ticks are not really negative. I mean, overall, looking at the price action of what we're seeing right now, we're not seeing, negative 500 ticks. So it's not really broad market sell-off. This could be just what summer trading is like, right? You get these sharp pullbacks. You get these gap up opens that we saw today that get sold into. I think this is pretty normal for, and I haven't looked at the volume, but I'm going to guess that the volume is kind of light too. This is a trade that we made a slight adjustment for last week, right? Remember, we initiated this trade with a small debit. We had about a 150 debit to put this trade on. What I did was I moved my long put from 4,100 down to 40.80. So essentially, I sold a 20-point wide put credit spread. I have collected a credit for this adjustment. That credit went to cover all of the debit, right? That 150 debit was covered, and that left me with 230 credit to the upside. And now with the market pulling back, I think that making that adjustment today would have been a better move, since we did not know what today's price action is going to look like last week. This position is still, in my opinion, it's fine. It's holding up well. We have very small directional exposure here. Delta is +8 or +0.8. So really nothing to do. Just kind of, wait it out. I would really start to kind of get not concerned, but I would look to make some kind of adjustments if we get down to about 40.50, right? So if my long put spread here goes in the money, I would look to make some sort of adjustments, because the lower we go, right, and this is a function of short or negative gamma, the lower we go, the more positive delta we start to pack on. And even at 40.50, this position is only going to be +2.8 positive delta, which is very light. Of course, this is per one contract. If you have 50 of these, then it becomes a little bit more of a directional trade. But I would look to make some sort of adjustments at 40.50 or below. But for right now, I think the best case here is that we chop around sideways. Maybe we go higher. We don't have a huge credit here. So if we do nothing else to this trade over the next 45 days, and let's say S&P goes to 44.50, the most we could make is the net credit that we had collected thus far, which is $230 on about $6,700 worth of risk, which is not a lot. But again, these kind of trades, if you think about it, right, if you make $230 on $6,700 worth of risk, which is 3.5%, I believe this trade was initiated at about 60 DTE, right? So if you take 3.5% over 60 days, and then you extrapolate it over the course of the year, and it's a 20% annual rate of return on risk, which is not terrible, considering the amount of attention that you need to pay or how active you need to be with this trade. If you can do that and generate a 20% return, I mean, that's, in my opinion, it's not really too terrible. Let's see what else we got. I have a Target. What's Target doing? Target is up today, just hanging around doing nothing. Right, we had a big move higher. Now we're just kind of consolidating sideways. It is currently at just a little less than 50% of max potential profit with 17 days to go. Based on current implied volatility, this trade has probability of profit of close to 90%. So again, one of those trades that you can choose to do nothing and just let time go and, maybe close this out in about a week. With 10 days to go, you probably should be able to capture about 50 to maybe 70% of max potential profit here. And I have bull put spread in the queues with 10 days to go. This price action in the queues is really not what we want to see, but I don't really think that the wheels are coming off just yet. So maybe we hold it for another week and we can see what this trade looks like in a week. If we see move to the downside of what is currently being priced in, this trade could potentially run into trouble. But if we have one expected move to the upside, this trade should be in good shape. So that's what I got. If you have questions, let me know. Otherwise, I'm going to jump at 11 Eastern and I'll be back on Slack. I'm also going to post whatever trades I do take. I will post in the Slack alerts channel. So for now, we're going to use the Zoom. I hope you guys like it. If you don't, or if you have any thoughts or comments, please let me know. They're all welcome. And we'll pick up on Wednesday.